Hey CMA buddies, let's today look at module 8.6 and 8.7 and we would be finishing module 8 with this. We'll be looking at one of the most important chapter from examination perspective, and that is balance scorecard, right? So please concentrate so that if any questions come from this topic, we are able to score to our level best, right? Okay, let's start with balance scorecard. Balance scorecard, I'm just telling you the definition. We will explain it. We'll try to understand it in detail, and maybe you would be able to understand it better as we progress further. Right? What exactly is a balance scorecard? It is basically a strategic performance metric. Metric means what? Metric is nothing but a technique of measurement or a unit of measurement. Right? So it is basically a strategic management performance metric that a company can use to improve internal business operations and external results. So basically the idea is why we use balance scorecard is that we can use the business operations within the organizations and eventually are able to produce good external results, or the outcomes are as we desire, right? So that is what is balance scorecard. So it is basically a strategic management performance metric that a company can use to improve two things. One is what? One is internal business operations, and the second one is improve the external results, right? It basically helps organization to focus on processes that when combined can help them meet their financial goals. So basic agenda of having a balance scorecard is that you basically can focus on the various processes that a company has so that they all can be combined. So for example, say there are 3 or 4 processes, all these 4 processes are culminated, which can eventually help you to attain what? The financial goals of the organizations, right? The sole purpose of setting objectives is to convert the mission and vision into specific measurable targets. So the basic idea or the basic objective of the balance scorecard is to convert what? Two things. One is vision and one is mission. This is something which we have discussed earlier itself. So basically the objective is to convert both vision and mission to what? Into specific measurable targets, right? So basically there are 2 types of objectives. Fine. One is what? One is financial objective, and the second one is called as a strategic objective. Fine. So the sole purpose of setting objectives is to what? Is to convert the vision and mission into specific measurable targets. Objectives basically are 2 types with respect to balance scorecard. One is financial and the second is strategic, right? Okay, let's understand what is financial objective. This is very easy to understand. It can relate to the financial performance targets that the management has established for the organization to achieve. So the performance targets that the company or the management has set up for the organization to achieve over a period of time, that is called as a financial object. What does it include? It basically includes increasing the annual revenues, right? So the financial objective can be increase your revenues either year on year or quarter on quarter. Annual increase in EPS. What is EPS? EPS is nothing but it is earning per share, right? So basically when you increase the earning per share, that automatically increases the value of your company and it also increases the shareholder returns. Fine. So 2 things. One is either you concentrate on increasing the annual revenues, increasing the EPS, increasing the shareholder values, which is ultimately the result of increasing the EPS, generating internal cash flows. So the more the cash rich the company is, the better market value the company will actually have. Fine. So this is the basic understanding of financial objective. So what exactly is financial objective? It relates to the financial performance targets that the management has established for organization to achieve. It basically includes techniques like increase, or other, it basically includes goals like increasing the annual revenues, annual increase in EPS, increasing shareholder value and generating internal cash flows. Fine. The second objective is what? Strategic objective. What exactly is a strategic objective? It basically relates to the target outcomes that indicate whether a company is strengthening its market presence, competitive position and future business prospect. So as we saw that financial objective is more to do with improving the financial condition of the company, strategic objective is more concerned about the target outcomes. Now what can be these target outcomes? They can be the other aspects. For example, strengthening the company's market presence. Fine. For example, you would have seen that Asian Paints have a competitor nowadays, that is Birla Opus. And they basically also have other existing competitors like Berger Paints, Nippon Paints, etc. So the basic idea of the company with respect to strategic objective of Asian Paints to be increasing the market share or for retaining the market share. So it says what? It says both strengthening its market presence, competitive position and future business prospects. So what they intend to do in future is also something that Asian Paints can actually look forward to. So you can remember a paint example and you basically can improvise on the strategic objective definition. Now it can include winning a certain percent of market share. That's what it says, strengthening the market share, achieving lower overall cost than the competitors. So your idea should be, your costing should be lesser than that of the competitors so that your profit margin automatically goes up. Developing better technology than rivals. That's what Asian Paints is actually famous for, because they came up with a well enhanced technology way before, right? So that actually helped them to gain a significant market presence, and no one was able to capture that market presence for a longer period of time. Having stronger national and global sales and distribution capabilities than rivals, etc. Fine. So the best example that can be of a paint company, right? So what exactly is strategic objective? It is basically, it relates to the target outcomes. That indicates what? Indicates the strengthening its presence of strengthening its market presence, its competitive position, and future business prospects. So three things is strengthening the market presence, second one is competitive position, and the third thing is future business prospects, right? What does it actually include? It includes gaining a certain market percentage share, achieving lower overall cost than competitors, developing better technology, and having stronger national and global sales and distribution capabilities than rivals. Fine. Okay. Now, method of combining the use of both strategic and financial objectives, tracking their achievement, and giving management a more complete and a balanced view of how well an organization is performing is known as the balance scorecard. So either you can say that balance scorecard is basically a metric that a company can use to improve the internal business operation and external results, or you primarily can define both financial objective and the strategic objective, and then you can say that method of combining both strategic as well as the financial objective, tracking their achievement. So the first thing is you basically you combine both strategic and financial objective, you track their achievement and give management a more complete and balanced view, or rather you give a picture of how the company is basically performing to the management. If you give all these, if you take all these parameters into consideration, then you would know how well an organization is performing, and that itself can also be called as balance scorecard. So you can define either ways, whatever you're comfortable with. Okay, it gives clear guidelines to the employees of the organization as to how their jobs are linked to the overall objectives of the organization. So basically it would give a framework or a guideline to the employees that how they are supposed to perform with respect to the overall objective of the organization. They can contribute productively and collaboratively to the achievements of these goals. So they can contribute, or they can be more productive, and they can work together, that is collaboratively, for what? For the achievements of the organizational goals. Right? Okay. Now what is BSC? That we have already understood. Now, who developed BSC, that is balance scorecard? It was developed by Robert S. Kaplan and David Norton of Harvard Business School. So please remember, it may be an objective type question. So balance scorecard was developed by Robert S. Kaplan and David Norton. Fine. Okay. It is a top-down approach to performance management. What do you mean by top-down approach? Top-down approach is nothing but decision is taken at the higher level and communicated to the lower level. So basically your board of directors will basically take the decision and convey it to the middle and the lower level management. And they got to act as per the instructions of the board of directors or the top level management. So that's what is top-down approaches. So BSC basically works on a concept of top-down approach. It starts with strategic intent and ends with operationally relevant targets. So you basically lay down a strategy, right, for the attainment of certain objectives, either financial or strategic. So that's why it says it starts with a strategic intent and ends with operationally relevant targets. So eventually we concentrate on the attainment of targets, or if you would have seen the definition earlier also, it says internal business operations and external results. So external results is something that BSC basically focuses on. So it basically starts with strategic intent and ends with operationally relevant targets. Now BSC model is based on 4 different perspectives. Very, very important, 4 different perspectives. How I remember it is, Freddy can't insult Lena, right? So FCIL. Let's have a look what exactly is FCIL. Usually what happens is, why I remember this way is, either one of the terms, if you forget, then you lose the crux of BSC. So for remembering it in a better way, I remember it as Freddy can't insult Lena, that is FCIL. FCIL stands for F. F is what? F is nothing but it is financial perspective. C is what? C is basically customer's perspective. I is what? I is internal business perspective. And L is what? L is learning and growth perspective. So Freddy can't insult Lena. That will tell you the 4 perspectives of balanced scorecard, right? Okay, let's understand what exactly is financial perspective. Financial perspective is nothing but it considers the financial measures. What are the various financial measures? It can be revenues, earnings, return on capital and cash flow rising out from the strategic intent of the organization. Nothing but what we learned in financial objectives, same is financial perspective. So it considers the various financial measures. So you can see what was the thing we learned when we learned about financial objective. It was increasing revenue. So revenues, earnings, that is EPS, return on capital, or you can say even ROCE, return on capital employed, and cash flows that arise from the strategic intent of the organization. Second one is what? Second one is customer's perspective. Okay, what does it say? It says that measures the ability of the organization to provide quality goods and service. So when it comes to customers, what is their idea of purchasing goods from your company so that they can get quality and they get good services? So basically it is the ability of the organization to provide quality goods and services. Then effective delivery and overall customer satisfaction, right? What all it includes market share, customer satisfaction measures, and customer loyalty. So these are the things that you need to keep in mind with respect to customer's perspective. Then we come to something called as internal business perspective. What is internal business perspective? These are the mechanisms through which the performance expectations are achieved. So basically you lay down certain metrics or mechanisms through which the performance expectations are achieved. So performance expectations of whom? Of the employees or the members who are working in the organization. Now how do you do that? It basically provides data regarding the internal business results that have led to financial success and satisfied customers. So it basically is amalgamation or culmination of the data regarding what? Regarding the internal business results, right? That would eventually lead to what? Financial success and satisfied customers. It is important to identify the key business processes that should be improved to meet organizational objective and customer satisfaction. So that is very much self-explanatory. So basically you have to identify the key business processes. So anything which is more relevant in the organization, that should be identified, it should be improved upon, and that would eventually help you in what? In attainment of organizational objectives and the customer satisfaction. And finally L talks about learning and growth perspective. So it is basically ability of the organization to manage its business. So how does the organization manage its business? It's all about learning and growth perspective. It adapt to changes in the environment. Fine. So 2 things. One is ability of the organization to manage its business with respect to learning and growth perspective, and second thing is how much they can adapt to the changes in the environment. For this, organization take on new responsibilities, right? What are the new responsibilities it takes? For this, employee skills and capabilities should be developed in order to cope with the changing environment and customer expectations. So if there is any change in the market, it is important for a company to render basically some learning or growth modules to the employees so that they can enhance their skills and capabilities. Now, for example, you would have seen that till now IT was working on certain aspects of skills. Fine. Now suddenly you can see that AI has come into the fray. That means a lot of the companies are now adapting AI, or the world itself is adapting so much of artificial intelligence. So what company needs to do? They need to enhance the capabilities or the skill set of the employees with respect to AI, right? So that's how that's how a learning and growth perspective becomes so very important, right? So basically you have 4 perspectives when you talk about BSc. One is financial. Financial talks about the financial measure. Customer perspective, that talks about the ability of organization to provide quality goods and services, effective delivery and overall customer satisfaction. Internal business perspective, that will give you data regarding what? Internal business that have led to financial success and satisfied customers. And finally, learning and growth perspective. So basically it includes 2 things. One is to manage its business and how the organization should manage its business, and at the same time adapt to the changes in environment. How would they how would they adapt to the changes in the environment? By giving new responsibilities to the employees. For that, they need to render skill set and they need to improve the capabilities of the employees. That can be done only through learning and growth. Fine. Okay, moving on. Last part of the topic, it talks about BSc approach involves following steps. So basically when you talk about balanced scorecard, there are certain steps that are involved in balanced scorecard. Let's have a look at that. First of all, establishing the organization's strategic intent, including the vision and mission. That's something we have already discussed when we are talking about balance scorecard. So the first thing that an organization needs to do is to establish a strategic intent, which includes both what vision and mission. So the keywords here are establishing organizational strategic intent, which includes both vision and mission. Second thing is you design the BSc. Fine. Once you have established what is the strategic intent, then you design the balance scorecard. This is determined by identifying the specific measures relating to 4 perspectives. What are 4 perspectives? Freddy can't insult Tina, that is financial, internal business, financial, customer, internal business, and finally you have learning and growth perspective. Now specific strategies that should be formulated and implemented to realize the organization's vision. So for that you have to design certain specific strategies which should be formulated and implemented for what? For realizing the organization vision and mission. Fine. Then you do what? You do strategy mapping. Now how do you do strategy mapping? This is done through identification of organizational objectives that are derived from the strategies. So strategy mapping is done through what? Identification of the various organizational objectives. How do you identify the organizational activities that are derived from they are basically derived from the strategies that are available. And finally, quantitative measures to be established to measure accurately the performance of the organization in specific areas. Right. So what are the 4 steps when you talk about the BSc approach? The first one is basically establishing establishing the strategy. You basically establish the strategy. Then the second thing that you do is you basically design BSc. Now this BSc is for what? This BSc design basically is done using the 4 perspectives, right? Freddy can't insult Lena. Fine. So you use FCIL, and then you do strategy mapping. Then the third thing that you do is strategy mapping, and finally what you do is you basically establish quantitative measures. Fine. Why this measure is important? These measures are important to measure what? Measure the performance of the organization. So these 4 steps you got to remember when we talk about the approach that involves the following steps of BSc. Fine. So with this we finish balance scorecard. Fine. Now you move on to the next and very small topic, that is EVA. EVA is what? EVA is economic value added. Fine. So we will talk about EVA in 8.7. Okay, before we understand EVA, we need to understand what profit is. We all know what profit is. Just a quick recap. It is basically a surplus of revenue over the cost. So your revenue minus cost is equal to what? That is profit. That's what is explained. Now what is this profit? Profit is basically something which is available for distributions to the owner of the firm, right? Whatever profit you have, that is something you distribute to the owner of the firms. Now basically profit is basically of 2 types. One is accounting profit and the second one is economic profit. Accounting profit we all know. We'll discuss economic profit because EVA, that is the economic value added, is directly correlated to the economic profit. Okay. Now economic profit is what? It represents a reliable measure of profit. That is a better measure of performance. Fine. Why it is a better measure of performance? It is basically a surplus available after all inputs. That's what is a normal accounting profit also is, but including capital. Fine. So when we talk about economic profit, it is basically a surplus available after all inputs including capital have been paid for. So economic profit is something which is taken into consideration, or rather it is the surplus that is available after the all inputs or all the costs including capital have been paid for. Right. So economic profit is also referred to as rent or economic rent. It is also called as rent or economic rent. A widely used measure of economic profit is EVA, economic value added. So the basic or the very prevalent measure of calculating economic profit is through EVA. Right. What is the profit? What is the formula for EVA? That is economic value added. It is NOPAT. NOPAT is what? Net operating profit after tax. So whatever net operating profit after taxes, that is EVA, but you got to subtract the cost of capital from that. That's how you define a EVA, because eventually you're trying to determine the value that is added to the organization. Now that can only be done after you remove the cost of capital. Fine. How do you calculate cost of capital? You would have seen it in financial management and business data analytics. The formula for cost of capital is capital employed into WACC. WACC is what? Weighted average cost of capital. right? So when you multiply the capital employed into the weighted average cost of capital, that is basically the percentage or the interest that you have paid, or the percentage of interest that you have paid on various sources. For example, it can be debentures, it can be preference shares, it can be equity shares. So once you calculate the cost of capital or the interest that you have paid on the capital that you have borrowed, that is called as cost of capital. That is called as cost of capital. So for example, if you have borrowed say 1 lakh rupees and the rate of interest is say 6%. So 1 lakh into 6% is what? It basically becomes 6,000 rupees. So whatever profit or NOPAT you have calculated, you're supposed to subtract this cost of capital from this, that is 6,000, and that will give you the EBA, right? So I'm not getting into details of it, but that's what is the basic understanding, right? So when you talk about economic profit, one of the core important aspects of measuring economic profit is basically EVA, that is economic value added. How do you compute economic value added? It is basically NOPAT minus cost of capital. And what is the formula for cost of capital? It is capital employed into WACC, that is weighted average cost of capital, fine? Okay, now what are the various advantages of economic profit over the accounting profit? Fine, we need to understand what is the benefit, or rather why this is more important than the accounting profit. First of all, it sets a more demanding performance discipline for managers. So when you talk about economic profit, it sets, or it gives a better parameter for demanding performance, or rather judging the performance with respect to the performance of the managers, fine? As per the experts, profitability disappears when cost of capital is taken into account. Experts feel that if you take cost of capital into account, that would basically reduce your profitability. So to have the exact profitability, what you do is you basically reduce the cost of capital. That's what is being referred here. Secondly, using economic profit improves allocation of capital between different businesses of the firm, right? If for example, businesses has various verticals, say it has 3 verticals, 1, 2 and 3. Fine. One is say a service oriented business, that for example we take a case of ITC. Fine. ITC has a hotel business also. ITC has a cigarettes business also, and ITC has food businesses also. Fine. So basically economic profits. So economic profit will determine how much capital should be allocated to each of the businesses, right? And the idea is to dedicate more amount towards what? Capital intensive business. So capital intensive business in here, this case would be that of food business, fine? So basically using economic profit improves allocation of capital between different business of the firm by taking account of real cost of more capital intensive businesses. So the idea would be here to concentrate more on the capital allocated to the highly capital intensive business, so that you are able to calculate the economic profit in a better way, or rather you can see your profitability in a better way, right? So that's what is EV all about, right? With this we finish module 8. I hope you like the entire series. Please don't miss any of the videos because it has a continuation. And if you do like this video, please press the like button, do share with your friends, and do subscribe to our channel, right? Very sooner we will be coming with module 9, right? So happy learning and enjoy.